As of the market close on June 26, 2026 at 4 p.m. EDT, Ondas Holdings Inc. closed at $7.83 per share, marking a solid 2.02% gain during the regular trading session with a daily trading volume that surged well past its historical averages. While mainstream traders frequently spend their days tracking big tech options or analyzing Tesla stock price swings, this specific defense technology firm has been quietly making structural changes that the wider market has completely missed. The immediate expectation for a small tech company like Ondas is that it is just another speculative instrument, prone to massive volatility and retail pump dynamics. The reality, however, is that while retail platforms see heavy daily action, institutional forces are paying serious attention to a massive backlog expansion that just cleared over $150 million in orders for the second quarter alone. If you look closely at how modern defense technology is scaling, you start to see that this isn't just about manufacturing small remote aircraft anymore. It is about integrated software networks that tie directly into global defense infrastructure, which changes the risk profile entirely. Most investors logging into their favorite online investing platforms look for security in large familiar tickers like Apple stock or Nvidia stock, assuming that smaller companies lack the institutional backing or revenue predictability to survive macroeconomic shifts. When choosing self-investing strategies, many people rely on tools like Schwab Intelligent Portfolios or browse generic investing sites to find standard index tracking assets. The general consensus surrounding Ondas has long been that it is a small hardware provider struggling to find a stable corporate niche. But when you look at the actual mechanics of their recent operations, that narrative completely breaks down. Just this week, their subsidiary Sentrycs announced a direct collaboration with Lockheed Martin to integrate its defense software into the massive Sanctum platform. This isn't a speculative pilot program or a simple marketing handshake. It is an active integration that places their communication protocol asset directly inside major global defense procurement programs. For anyone using an individual brokerage account to find asymmetric upside, this specific development serves as a perfect example of where market expectation diverges sharply from operational reality. Let's look at the actual flow of capital and trading volume over the last several sessions to see what is happening underneath the surface. When you look at platforms like Interactive Brokers Trading or track order routing through a high-end Fidelity trading platform, you can see a distinct shift in who is accumulating these shares. In past years, the stock experienced intense volatility because it was heavily traded via retail mechanisms like the Robinhood app or through simple SoFi active investing accounts. Retail traders would pick up shares based on short-term hype, leading to sharp spikes followed by sudden drops. However, the current volume profile reveals a steady, calculated accumulation pattern. When order flow moves into an Interactive Brokers platform or gets processed through major institutional channels at Fidelity Brokerage, it usually signals that long-term managers are building positions based on fundamental valuation gaps rather than social media chatter. Analysts have noted that the stock could be significantly undervalued given its current revenue trajectory, with some major Wall Street firms maintaining price targets well into the double digits. To understand why this gap exists, we have to talk about how people manage their wealth and investment selections today. If you are handling a portfolio through Fidelity Investments or selecting specific assets for Fidelity IRAs, you are likely looking for companies with visible cash flows or immense structural advantages. The common trap with smaller technology firms is that they run out of capital before their products hit commercial scale. Ondas has historically faced this exact skepticism from the broader market. Critics continually point to past operational losses and the ongoing risk of equity issuance as reasons to stay away, preferring safer vehicles like Fidelity mutual funds or low-cost Fidelity ETFs. But the massive influx of $40 million in new defense contracts in June alone completely shifts the near-term liquidity picture. When a company manages to book over $150 million in a single quarter, the conversation changes from existential survival to operational execution and margin expansion. This structural shift is precisely why the stock is demanding a closer look from anyone participating in online investment activities today. If you open your Robinhood stock trading panel or pull up the SoFi trading platform, it's easy to get distracted by daily chart patterns and minor price fluctuations. The real story is hidden in the strategic acquisitions that Ondas is executing to build out its business model. Take their recent announcement to acquire Cyberhawk for approximately $125 million. This move expands their footprint directly into critical infrastructure intelligence. Cyberhawk isn't a pre-revenue startup, it is a mature business bringing in tens of millions in highly predictable, recurring revenue with hundreds of enterprise customers globally. For a self-investing participant using an intelligent portfolio approach, this acquisition helps bridge the gap between lumpy defense contracts and steady, predictable software-as-a-service revenue. Let's consider the broader competitive landscape for a moment to see how this fits into a modern portfolio. Many automated platforms like the SoFi Robo-Advisor or various customized baskets on popular investing sites tend to overlook companies under a certain market capitalization threshold. They pour billions into massive secular trends, driving up valuations for crowded trades. Meanwhile, specialized operations like Ondas's high-altitude balloon division, which was recently selected for the United States Navy Maritime Domain Awareness Program, get categorized as secondary pieces. The market expects these projects to be isolated experiments. The reality is that by combining stratospheric monitoring with automated systems and advanced communications, they are building an integrated security stack. It is a system that allows different defense layers to communicate and intercept threats without relying on traditional, easily jammed radar or kinetic force. Comment below how many shares of Ondas Holdings you currently hold, or if you are tracking this stock on your watch lists. When we break down the core business model, Ondas operates through two primary segments that address massive, high-barrier markets. The first is their wireless networks business, which provides private, high-capacity data networks for railroads, utilities, and critical infrastructure. The second is their autonomous systems division, which includes advanced drone platforms designed for automated security and industrial data collection. This dual structure creates a fascinating dynamic. While the market treats the company as a pure-play defense stock, subject to the whims of government spending cycles, it actually has a deep commercial footprint. The private networks they design form the backbone of critical industrial communications, making their technology incredibly sticky once a customer integrates it. This isn't a product you simply swap out for a cheaper alternative. It is foundational infrastructure that clients rely on for daily operational safety. Looking at older reports and past performance, it's clear why the market was hesitant for a long time. The financial statements from previous years showed heavy spending on research and development, which consistently depressed net income and forced the company to raise capital through equity markets. This history of dilution is exactly why many conservative investors, using traditional online investing tools or advisory accounts at Fidelity Wealth Management, opted to pass on the stock. They saw the technological promise, but were spooked by the cash burn rate. But the recent inflection in their order backlog indicates that the heavy investment phase is starting to give way to commercial monetization. When a company manages to book over $150 million in a single quarter, the conversation changes from existential survival to operational execution and margin expansion. The options market is also reflecting this heightened tension between expectation and reality. If you look at the implied volatility on contract expiries throughout the coming months on an Interactive Brokers account, the options chains are pricing in massive expected moves. This indicates that professional market makers are anticipating a major resolution to the current price bottleneck. Traders using Robinhood Crypto or Robinhood Cash Management might be used to wild, unstructured swings, but the options activity here suggests sophisticated positioning. Large institutional blocks are buying up calls, protective puts are being placed, and the overall implied volatility skew suggests that the market is beginning to wake up to the revenue reality that this company is building. It shows that the days of this stock flying completely under the radar are likely coming to an end. As we look toward the future outlook and potential scenarios, the core catalyst to watch will be the speed of execution on these massive second-quarter orders. The main risk that investors must weigh is whether the company can successfully integrate its new acquisitions, like Cyberhawk and Omnis, without experiencing operational friction or needing to return to the capital markets for additional equity funding. If they can manage their cash flow effectively while fulfilling these contracts, the upside potential relative to their current market cap could be substantial. On the other hand, if execution stalls or if integration costs run higher than expected, the stock could easily find itself testing its previous lows as the market penalizes them for failing to turn orders into actual profits. This is the classic balance of risk and reward that defines small-cap technology investing. In summarizing these insights, the central theme remains the stark contrast between what the general market expects and what the operational reality shows. The market sees a volatile, unprofitable micro-cap stock that is too risky for a standard investment strategy. The reality shows a company that has secured over $150 million in quarterly orders, integrated its core asset